Good day. Welcome to our regular class on investment analysis and portfolio management. This is lecture number 33, and we are on our way to almost going towards the more and more exciting part of the portfolio management aspect. But right now we will talk a little bit about risk, and we talked what risk was. Risk is not only anything to do with finances. Risk can be in your daily walks of life, anything to do with some untoward eventuality or incident would be a risk. So it could be just walking on the road, maybe driving the car, or then yes, particularly investing in the capital markets. But then risk is also about returns, and we talk about investments and the risk and return trade-off, and that makes investments very exciting. Always we do mention more the risk, more the gain, no risk, no gain, and with risk there is pain but gain. So investing in stocks or investing in bonds will have risk, but there is going to be a difference in the level of risk. Obviously, we're talking about more risk or less risk. Capital markets, investment analysis, and then stocks is definitely risky. Bonds is not as risky as compared to stocks. We talked about the two different kinds of risk, and we talked about general risk. Risk that you will maybe not be able to control, risk that is in a macro aspect, risk that is in a generalized effect. So this would be a systematic risk and will be more towards macro things involving your particular industry or your particular company. This is pervasive, affecting everything, affecting all securities, all portfolios. So this would be maybe what? Interest rate risk, market risk, inflationary risk. It will not only be bothered with your particular share, but will be on all shares across the board. So you could have systematic risk or generalized risk, or then you could have non-systematic risk or specific risk, which is focused onto your company. What am I talking about? I'm talking about maybe union issues, maybe I'm talking about strikes, maybe I'm talking about some untoward incident in the productivity of your product in your factory. So this would be a particular specific risk, which would mean what? Total risk will then have general risk and specific risk. So we've got to look after both types of risk. And what do? We diversify. Diversification is the name of the game, in which you can maybe try to dampen the effects of total risk. So total risk can be avoided through diversification, and that is why we have talked about diversification. Diversification would obviously mean diversifying different shares. So we look at the different sources of risk, and then we can talk about maybe interest rate risk or market risk or inflationary risk or business risk or financial risk or liquidity risk or exchange rate risk or country risk. There's so many risks involved, and we have to be on the lookout for all these sources of risk. There can be one, there can be two at a time, there can be many at a time. Of course, crisis comes in hordes, never come alone. So risk can be multiple. It can be singular, but you have to look at all these different kinds of risk. And we talked about all these in detail, but particularly so if a foreigner or foreign investment scheme, they'd be bothered about sovereign risk. They'd be bothered about inflationary risk. They'd be bothered about exchange rate risk and maybe market risk as well. But if you talk about credit or default risk, we're focusing on the context of the company being unable to pay back whatever they've borrowed. We'd be talking about risks maybe. That is why we would consider going into government-backed securities, because the risk is less of default. But in corporations, obviously, we'll be looking at more factors looking at credit risk. So we'll have to look at the credit or default risk. Country risk. Maybe if you're not investing in our country, investing in another country, then we have to look at the sovereign guarantees. We have to look at how the country is politically vibrant, politically secure. Maybe there is no intervention by uniformed sources. we have to look at all these things to be looking at a corporate and a country risk. We have to look at what is the exchange rate of the country. If we're looking at our own country, we have to look at factors that will let us know what is the exchange rate. Every time there is a difference in exchange rate, we'll find problems in our own tradings, we'll have problems or our investments. While we're talking about the interest rate risk or inflationary with exchange rate risk, we've looked at interest rate. Every time we see a hike in the discount rate, every time we see a hike in the interest rate by the central or federal government or at the central bank level, we find stock market prices going down, because then you find it a better place to invest. If you're looking at political risk, we have to look at what is going to be the effect of political decisions and political instability on your investments horizon or your company in which you focused on. Market risk is more like everyday ups and downs, volatility is not very bothersome, but yes, for people who are into trading and not into portfolio management or investments, yes, market risk can play a role as well, but nothing to worry too much about, because this is short-term, small and fractional. Now, if we were to look at the relationship or the trade-off between expected returns and risk, we would look at, which means the investors would look at the costs involved and would mean, if there's more cost, would mean lower returns or lower expected returns. So we need to understand any level of expected return has to do something with risk, and this can be achieved by minimizing risk and increasing levels of return. And we talked about having more gains in stocks. Having more gains obviously means more risk involved, and lesser gains in bonds, and obviously we're talking about lesser risks as well. And then we have a risk-free return rate, which would mean the least rate of return but the least level of risk as well. So we put on stocks at the highest level when talking about returns, high returns and then high risk. So we talk about asset valuation. We talk about what asset valuation, it is a function of what? It is a function of both return and risk. We talk about returns. When we talk about returns, we have to talk about risk, because we cannot avoid risk. This is paramount for us to understand that risk is there for us to counter. So it is the center of security analysis, and what is at the center of asset valuation. And when talking about asset valuation, talking about fundamental analysis. So we talk about how should we measure this, and we can talk about realizing the risk-return trade-off based on the past, or we can talk about expected risk-return trade-off based on the future. The risk-return trade-off on the past, which is realized, is calculable because that's done. But the expected part is not so calculable because it's in the future, and future is unobservable. So we look at the return components when we're talking about risk and return trade-off, and we can talk about periodic cash flows, which would mean what? Which would mean dividends, which would mean interest being earned, which would be about yields, which would mean yield measures return on income and the price of security. So we talk about yields, we talk about dividends, we talked about incomes or cash inflows, and then we talk about price appreciation, which means capital gain or capital loss as well, because it's all about gains and losses, not a one-way ticket to success. The train goes both ways, goes south, goes north. We need to know where we're traveling so that we can talk about profits and losses. So looking at ground realities, we need to understand what is this all about. It's all about arithmetic and it's all about geometry. Meaning what? We're talking about simple interest and simple returns, and we're talking about cumulative returns or compounding returns, which means that we're talking about compound growth rate. We're talking about the arithmetic mean not being able to measure the compound growth rate over time, which means arithmetic does not capture the realized changes in wealth over multiple periods of time, but it does capture yields, typical returns in a single period. But geometric means returns means reflecting on compound cumulative returns on more than one period. When we're talking about cumulative returns, we're talking about reinvestments. We're talking about reinvestments over different periods of time. We're talking about compounding the effect of profitability. We're talking about compounding the effect of returns. Obviously, I don't need to hammer it in. Compounding has better returns to give you than simple returns. So if you're looking at compounding, we're looking at more returns, we're looking at future growth as well. But obviously, all this comes at a risk premium. So we can have maybe what? We can have two asset classes of risk premiums, which would mean equity risk premium or bond horizon premium. Now, equity risk premium would be the difference between stock and risk-free returns. On the other hand, bond horizon premium would be the difference between the long and short-term government securities. So we have to understand that the premium is the additional return earned or additional premium earned on expected and additional risk. You take an additional risk, but up till a limit. And then we can talk about equity risk returns and bond horizon returns. So when we're talking about returns, we're talking about measuring returns. We're talking about how we measure and why we measure returns. We measure it for comparing performance over time or across different securities. We've got to do comparisons of different investment decisions. We need to understand that total return is a percentage relating all cash flows relating received during a given period of time, which would mean that total return can be either positive, yes, and negative too. We're talking about both sides of the game. We're talking about both sides of the court being plus or being minus. So a relative return solves the problem because it's always positive. That's the difference between measuring returns, because we can understand the returns when we're measuring them, and a relative return can sort out matters which cannot be solved. So we understand that to measure return, we talk about wealth being created. We talk about wealth being created because of investments, and investments giving you returns on your investments over a period of time. And when we're talking about investments, we're not talking just about local investments. We're not talking about regional investments, but we're also talking about international investments, which would mean getting returns in international currency, which will obviously be only when there is a realization of an exchange rate difference or an exchange rate change. So if foreign currency depreciates, we will understand the returns shall be lower in domestic currency. On the other hand, if foreign currency appreciates, the returns in local currency shall also grow. So we talk about international investments and returns and domestic investments and returns. The bottom line is that we've needed to understand what is the best vehicle to earn more, lose less. So we need to understand, when we're talking about time value of money, we're talking about interest rates and inflation. So when we're talking about inflation, we need to understand that returns measures are not adjusted for inflation. Purchasing power of investment may change over time. Also, the CPI, the Consumer Price Index, is possible measure of inflation. Unless we can measure inflation, we cannot know what sort of returns are we talking about. So whenever we are investing, whenever we're wanting to talk about returns, we have to talk about inflation and adjustments and kitchen price index and consumer price indices. These are things that we need to know. What is the actual realization of returns? So we need to understand inflation. We need to understand the consumer price index or the kitchen price index, and then we can measure risk. And how do we do that? So then risk is the chance that the actual outcome is different than the expected outcome. Remember, the actual and expected are two different theories, two different aspects that we need to understand. And then standard deviation measures the deviation of returns from the mean. Obviously, we're talking about describing standard deviation being separate from volatility or from the average. So more the deviation, more you can expect volatility and more the chances of profits and losses. But risk is the chance that the actual outcome is different than what you had actually anticipated, or which you had maybe calculated or hypothesized or focused on. So then when we're talking about measuring risk, when talking about inflation, and we need to understand that there has to be some sort of an investment decision which would make things better. So, if we look at the underlying investment decisions, we would look at the trade-off between expected returns and risk, which would mean expected return is not usually the same as realized return. Risk is the possibility that the realized return will be different than the expected return. So the risk-return trade-off cannot be duly understood unless we understand time value of money, inflation, risk, and the risk-return trade-off. So it is important for us to understand, but you need to understand that you don't need to take unnecessary risk, because unnecessary risk will not give you, definitely not give you unnecessary returns, but of course it will give you unnecessary restless, sleepless nights. But then the investor's decisions are most important aspect of the investment horizon, and that we have to understand. That these investment decisions are going to be the key factor in for you to make more money or less money, more losses, or stopping your losses from really going bad. So investment decisions have to be focused on risk. And how much risk are we talking about? Or how much risk are we willing to take when we're talking about the investment decisions? This is important for us to understand, because investments is about risk and return. When we talked about risk and return, we should have understood that risk is the possibility that the realized return may not be the same that was expected, and that could disturb the cash flows of any investment decision. When we're talking about cash flows, we're not only talking about core investments, we could be talking about investments in a product making a productive line, or an industry making some products, or just having bought investments as part of the investment process and dealing only in equities. But we need to understand that this is actually, in the layman's terms, called the iron stomach test, which would really let you know how much you have in your, how much peptic juices you have for you to absorb or digest. It will all depend in your capacity, in your ability to digest what sort of risks you're willing to take. So when we talk about investment decisions, we talk about the investment decision process, and this is the two-step process, which means security analysis and valuation. So it is necessary to understand security characteristics. And when we talk about security characteristics, we must understand then we are talking about portfolio management. We've talked a lot about investment analysis. We've talked about sectoral analysis and industry analysis and company analysis. But we need to understand portfolio management as well. And we need to understand that these selected securities are viewed as a single unit when we're talking about a portfolio. Because this is a basket. The basket where you're going to put in all your eggs, and you're going to watch for those eggs not to fall and break themselves. So how efficient are financial markets, and how efficient is the processing of new information that's continuously flowing in? And we talked about this in gathering information and the efficient market hypothesis. This is what we talked about. And then how should we make revisions, and how should portfolios be revised? That is interesting to note. And then how should portfolio performance be measured? When we're talking about portfolios, we're talking about a number of diversified products. When we're talking about a number of diversified products, we're actually talking about different equities or bonds and equities, but are going to be using a basket, maybe a mutual fund or a portfolio, to discuss all of the different shares, equities, bonds, money markets as a single unit. And then we can look at the different earnings that are coming in from bonds, which is going to be lesser than equities, and then compare it and average out and find out what is the total return of that particular portfolio. So then you would be talking about asset management, which is another word for portfolio management. So it is all about managing funds. be it financial management, be it portfolio management, be it asset management. These are different names, but the bottom line is you're going to be managing finances. You're going to be managing assets, or you're going to be managing portfolio, which need not be just cash, which need not be just equities, which need not be just bonds, but a blend. And of course, there are more words to just equities, bonds, and money income. There's also derivatives. We haven't talked a lot about derivatives, but don't you worry, we'll talk about derivatives when the right time comes. But until then, let's focus on the portfolio and how are you going to talk about efficiently understanding the returns or understanding what is going to come to you. So we look at the basic strategies. We look at the basic decisions and whether we're going in for fixed income or we're going in for variable income. But talk about the basic decisions on fixed income management. The idea is whether should we do it passively or should we do it more actively. So when we're talking about strategies, we're actually talking about passive management or we're talking about active management. Wonderfully spoken. These two will have different results. These two will have different levels of risk as well. These two will have different sorts of iron stomach tests as well. But when you're talking about an active strategy, we're talking about finding more secure, superior returns from the fixed income portfolio to an active strategy. Of course, having said that, superior returns can be earned if the investor can predict interest rates. When the investor can predict where the interest rates are going to go, whether there's going to be a hike in interest rate or there's going to be a lack in the value of the interest rates. It'll all depend on the numbers of monies available for the federal government to use. If they're too much, you're flush with cash, they'll lower down the interest rate. But if they're strapped for cash, they'll hike the interest rate, hike the discount rate, and then you'll see a result on the bonds as well. But we must understand if the investor can find mispriced bonds, if the investor can find underpriced bonds, will all depend his or her ability to predict where the trend of the interest rates is going. For example, finding a bond that has a credit risk premium that is too large for its credit risk, or passive management would involve controlling risk and balancing risk and return. If we're talking about active investments or we're talking about passive investments, we're also talking about costs. When we're talking about costs, we're talking about commissions that you have to pay every time you swap from one bond to another bond. Obviously, this is not going to be very frequent because bonds are not something that you can sell and buy as easily as stocks, but definitely switching over incurs cost. When you incur cost, it will affect your returns as well. And when we're investing, when we are managing portfolio, especially if we're doing portfolio management for somebody else, our performance will depend on the numbers of monies we've earned for somebody. If we were looking at fixed income passive investment or fixed income passive management, we'd be talking about bond index funds. We'll talk about bond index fund in a while, but before that, we need to understand we talk about bond index funds, and in fixed income passive management, we'll be looking at immunization of interest rate risk. We're looking at safety procedures to avoid from interest rate risk, which would mean a net worth, a total immunization. When talking about total immunization or net worth immunization, we're talking about duration of assets. I told you all about duration and how important it was and how different it was from maturity, except in zero coupon bonds, where duration and maturity is the same, but for coupon bearing bonds, maturity is shorter than maturity. So you talk about duration of assets, and we talk about duration of assets equal to duration of liabilities. You have to square off liabilities and assets in the duration to understand immunization being the impact of avoiding interest rate risk. Plus, we need to understand that the target date immunization. We talked about maturities and durations being different. We talked about target dates immunization in a different horizon than net worth immunization. So we talk about holding period, matching duration. Maybe we're talking about zero coupon bonds because that's where you'll find duration and maturity to be the same. And we have to also look at cash flow matching and dedication towards passive management. Passive management will let you buy and hold. Passive management will let the other people do all the work for you, meaning there's going to be a lesser amount of returns in passive management, but it's going to be at least safer and not give you too many ulcers as well. So passive management is for people who are not very excited about returns, who isn't though, but are not willing to take a lot of risk. Passive management will help them realize a certain amount of return, but will not really let their funds grow. Obviously, when we're talking about the bonds growth, we're not comparing it with stocks, because bonds growth is going to be substantially lower than stock. Of course, the returns are going to be lower, but so is going to be the risk. The risk is going to be lower, but safer. Now, back to bond index funds. We have a stock index fund. We also have what? We have a bond index fund as well. So if we talk about bond index funds, we could be talking about a lot of bonds on which an index is based. Like I told you, let's assume there is a 100 stock index fund, or there's a 100 stock index benchmark. You could have a bond index fund. So you would have what? You would have return rates of different bonds combined and then averaged out, or based on their capitalization, you could find out what is going to be the index fund returns, and then you can passively manage the fund. So we look at immunization, and immunization is protecting yourself. If you look at contingent immunization, then we are talking about a combination of active and passive management. This is what contingent immunization is all about, because we're talking both of active and passive safety measures. Also, this kind of strategy would involve active management with a floor rate of return, a minimum rate of return, a benchmark where you'll be finding out, of course, this is active management, we're not going any lower than this rate of return. So this is going to be floor on the rate of return. Now, as long as the rate earned exceeds the floor, the portfolio is actively managed. You have to stay above ground level. We're talking about returns greater than the floor level, which would mean that if you're earning more than the floor level, you're actively managing the bond market investment portfolio. So you're talking about contingent immunization, having a blend of both active and passive management. So once we're talking about being ahead or above floor levels in interest rates, what happens when you reach ground levels or reach floor levels? So once the floor rate or trigger rate is reached, the portfolio is immunized, meaning you have safety measures of not going below that measure. This is something that we talked about in stocks as well. We talked about having a stop loss. We talked about, not letting your stock prices fall below a certain level. Similarly, when we're talking the same thing in passive and active combination management and contingent immunization, we're talking about strategies that involve active management with a floor rate of return. It is important for us to understand all this. So we need to understand what are the factors affecting the process. What are the different factors that we need to look at? What are the factors that we need to be careful about? What are the factors we should be happy about? We're talking about uncertainty in an ex-post return dominating the decision process. So, what I'm trying to tell you is that uncertainty in ex-post returns dominates decision processes. Uncertainty rules investment decision. Uncertainty rules the realized returns compared to expected returns, and uncertainty makes you or breaks you. So future is unknown in uncertainty, and you can only make a good estimate. You can make a guesstimate. In educated, you need to hit the target right with a good estimate. That is what you can do in uncertainty. Hitting the targets right. Future is unknown, but you must estimate correctly. So we're talking about factors affecting the process of decision. One was uncertainty, another is foreign financial assets. There is an opportunity to enhance return or reduce risk. We're talking about foreign exchange risk as well. So you can improve your earnings and reduce the risk by looking at the interest rate or the foreign exchange rate as well. Other factors that could help is quick adjustments. Quick adjustments are needed to a changing environment. You need to make quick adjustments. You need to swap. You need to hold on to your positions. You need to find out if you're going to have more uncertainty, you can get rid of all the investments and wait for a better time. You can sit on the sidelines, look at the right time to invest. You can also look at the internet and the investment opportunities. There's a lot of opportunities on the internet, and why do I say that? Is because of globalization. I talked about that because of e-commerce. I talk about e-industrialization because the world is at your feet, rather at your fingertips, because you can do as you please, you can invest where you want to. All you need to have an internet connection and the money, of course, and the wallet to support your decisions. So institutional investors are another important factor. When we're talking about institutional investors, we're talking about huge sums of money compared to individual investors. Obviously, individual investor has his own importance, but institutional investors will actually, let you follow them. Because there's large sums of money involved, so they need to be looked at seriously. When we're talking about bonds, when we're talking about risk, when we're talking about investment decisions, let's go on to bigger things. And we talked about making investment decisions, and we talked about active and passive management, and we talked about contingent immunization. These are things that make you feel more comfortable making investment decisions. I wonder if we talked about portfolios. All the time I'm taking this word to you, portfolio management, investment analysis, but we really haven't done much on portfolio management. So this is your day to think about portfolio management. So let's talk about portfolio theories. What is this all about? What is a portfolio? It is what? In portfolio theories, we'll talk about investment decisions. We just did that a little while ago as well. In portfolio theories, we talked about the different types of decisions that we make. Obviously, which means what? It involves uncertainty. Once again, this word comes up. We talked about this 5 minutes ago. Involves uncertainty. Involves the future. Involves the unforeseen future. Involves just groping in the dark. Involves you making the right decision. Involves hitting the targets right about the future returns, future interest rate, future earnings, future investment decisions. Solve. Why are we investing for the future? So do you do that? You have to make investment decision that will involve uncertainty. So you focus on expected returns. Expected returns, which is different from realized return, can be the same. Most of the time it's different. So you focus on expected return because of uncertainty. You focus on expected return. You do not focus on confirmed returns because that's not possible. You estimate. The estimates of futures returns need to be considered, and you need to manage risk as well. So you look at the goal at which you're aiming at. So the goal is to reduce risk without affecting returns. That is the beauty of investment decisions. Returns being the same, you're minimizing risk. Anybody can do better by minimizing risk, of course, reducing profits as well. We're talking about not reducing profits, reducing the risk, and that's about investment decisions. This can only be accomplished by building a portfolio. So, when we talk about building portfolios, we talk about diversification once again. We talk about shifting your risks to a more diversified level. We talk about differentiating between good investments and bad investments. Since the paramount word is uncertainty, we have to know how to deal with uncertainty. We have to know how to talk about uncertainty and find out that it is the risk that an expected return will not be realized. What am I talking about? I'm talking about expected returns not being the same as you would have thought you would get back as returns on your investment, but that's the way you live your life. Investments is all about the future. You don't make decisions. You don't predict futures. You don't dictate futures. You try to get and blend yourself with whatever is coming to you. You try to do it in a big way. You try to do it in a bigger way, better way, by deciding what is the return going to be. So, investors must think about returns, distribution, diversification, not just a single return. When we talk about returns, when we talk about investment returns, we talk about returns on investment in a diversified, multivariant way, and not just returns from a single product or a single investment. When we diversify, we are spreading our risk, we are spreading our returns as well. So the probabilities weight outcome. It is about probability, it's about uncertainty, because we're talking about the future. We're talking about times for unforeseen, and we need to understand that the returns can be different than what we've been expecting. It's not going to be a precise decision by you what your inflows are going to be. Inflows may be different from outflows. Inflows may be different from what you perceive to be the best returns for you. So we've looked at uncertainty in different ways and dealing with uncertainty. When we're talking about uncertainty, we're talking about being discrete or continuous. We're talking about probabilities should be assigned to each possible outcome to create a distribution. Distributions are going to be different when they're going to be different investment horizons. More or less, we're talking about diversifying because we're talking about portfolios. The only reason we're talking about portfolio is trying to minimize risk and increase profit. If it's a single item, we would have enhanced risk and maybe enhanced returns as well. But it's a do-or-die situation in a single investment. You never do that. Any sensible person, that's the difference between a boutique and a departmental stores, because you've got more variation, to use as investment or buying than just boutiques specializing in one individual or particular product. So it helps to diversify because it helps reduce, minimize risk. It helps increase profits. When we're talking about diversification, we're actually talking about, safety. It's a pressure cooker. There's so much pressure in the capital market. We need to put in something that would give us some sort of a relief. Let the steam out. You do that by diversifying. We talked about eggs being put in one basket, or eggs not being put in one basket, or watching the basket with all the eggs in one basket. So we need to understand something, and that is, we need to understand what expected return is. We're not talking about realized returns, we are talking about expected returns. So how do you calculate expected returns? When you're talking about calculating expected returns, we talked about expected values. There's no certainty. Remember, we're talking about uncertainty as well. Keep in the back of your mind, we're talking about uncertainty as well. When we're talking about uncertainty, we're talking about expected values. There's no such thing as certainty, so there's going to be no such thing as for sure confirmed values. So expected values are going to be looked at when talking about calculating expected returns. So the single most likely outcome from a particular probability distribution is the expected value. What is the expected value? Once again, for your convenience, expected value is the single most likely outcome from a particular probability distribution. Expected value is the weighted average of all possible return outcomes. You're looking at different probabilities, we're looking at different horizon, we're looking at different incomes coming in or returns coming in. Then we could talk about return or expected value being referred to as an ex ante or expected return, which would mean that you would be looking at fairly good guesstimate at what you could expect from a particular investment or a basket on investment, because when talking about portfolios, we're talking about a basket of investments. Then if you're talking about a basket of investments, every instrument, every product, every investment is going to give you a different return. A few might give you the same returns, but mostly you're going to be incorporating different returns coming in to that portfolio. Why? Because all products, all investment decisions, all equities, all bonds have got different internal inherent strength, which will make the difference between very good earnings, average earnings, or below average earnings. And that is why we spread our risk. You spread. You reinsure yourself. Why do you get yourself insured? You get your insurance because you're spreading risk. You're paying out the premium so that somebody can take the risk of letting you drive your car peacefully. So you spread your risk through portfolios, and I was talking about calculating risk. We talked about calculating risk and expected returns. We talked about variance. Actually, we didn't talk about variance and standard deviation. We mentioned variations, and we've talked about variance, and we've talked about means, and we've talked about standard deviation. But if you're calculating risk, we need to look at the variance and standard deviation being used to quantify and measure risk. These are good methods to, quantify risk, standard deviation and variance. So this will help measure the spread in the probability distribution. Remember, it's all about probabilities. We're not talking about exacts. We're not hitting everything on the nail every time. We're going to miss some, hit some, injure our thumb as well. We're talking about measures that spread the probability distribution. We talk about variance of returns. We talk about variance of returns, and we talked about standard deviation of returns. We talk about different methodologies in looking at what standard deviation is going to help you in and what variance is going to help you. So ex ante is rather than the ex post ante or relevant. It's important to understand expected return. We must adjust ourselves. We must make room for the uncertainty. We must not panic that we haven't been able to realize returns the way we had expected them to come to us. In doing that, we must keep the room of error there. There has to be room for us to look at when things don't work out the way we had calculated them. Because we're calculating or estimating future earnings, and we're talking about future returns. And in doing that, we were also calculating risk. Right now, we talked about variance and standard deviation being used to quantify and measure risk. Of course, this would be as variance of returns or a standard deviation of returns. This is important for us to understand when we're talking about calculating risk. Unless we can calculate returns, and unless we can calculate risk, we cannot talk about returns and risk in the same sentence, because returns will come with risk. Especially we are talking about returns beyond normal capacities. We have to understand that these expected returns will have to come with being able to understand the risk factor, and to measure risk or to find out, quantify risk, we need to look at standard deviation and variance. Now, we're talking about portfolios, we're talking about diversification, and we're talking about expected returns in a portfolio. The portfolios don't have perfect, calculated, precise return. They will have expected returns. And since portfolios are going to have a variety of different products in their cells, they'll have different returns which you can expect. So you look at the weighted average of the individual security expected return. Each security average return. You look at the past data and find out what the historical values have been and what the expected growth can be based on earnings growth in the past history of a particular security. You can look at the weighted average, put more weight and look at averages, and you can expect returns based on the past, based on fundamental analysis, basic asset valuation. Maybe we're looking at dividend discount models. Maybe we're looking at the Gardner's growth model. We're looking at companies with returns. So you can look at these as weighted averages on your portfolio. So each portfolio asset has a weight. When each portfolio asset has a weight, we look at it as a figure, let's say W, which represents the percent of the total portfolio value. Just have a quick glance at the equation in front of your screens. You'll be able to understand how W, which represents the percentage of the total portfolio value, works out for you. When we're talking about diversification, this is what we were actually talking about. We were talking about diversified returns as well. We're talking about expected portfolio returns, because we're looking at portfolios as a whole, but we'll have individual returns coming in inside the portfolio. We're going to collect all the individual returns coming in, have an average, weighted average, and then spill out the beans and let the people know what we've actually earned. And of course, we can always swap over and switch over to things that are maybe not performing as well, and of course will maybe not perform as well in the future as well, so we can switch over to better things. You don't need to be stuck with one share all the time or one investment all the time and be stuck with earnings. So you can always improve. This would be what? This would maybe be active portfolio management. You just don't sit and hold. You look around and find ways of improving your investment. So we look at how portfolio's expected returns can be measured with the portfolio's risk as well. Now, when we're looking at expected returns, we need to understand the risk factor as well. So, portfolio risk does not simply be the sum of individual security risk. We're not talking about individual securities as the risk of the entire portfolio. The emphasis is on what? The emphasis is on the rate of risk of the entire portfolio and not on risk of individual securities in the portfolio. We're talking about individual stocks. Yes, individual stocks are risky only if they add risk to the total portfolio. But they're just part and component of the portfolio. They are part of the portfolio, but cannot override the portfolio's returns. And we can, like I just mentioned a couple of sentences ago, do away with that particular stock which is risky. So individual stocks are risky only if they add risk to the total portfolio. Now that would mean what? Does the individual stock have a bigger risk factor than the rest of the entire portfolio? If that was the case, then that was a really bad investment decision you actually made in the first place. Because one individual stock cannot outperform the one portfolio, or maybe it cannot also give you the actual risk to the entire portfolio as well. So an individual stock will stay as an individual stock as far as risk is concerned, but cannot be big enough to outweigh the entire rest of the portfolio. Let's say we're talking about 10 shares, so maybe if one share is heavily risky, it doesn't need to be as big a risk as being able to do what? To be able to outweigh the risk of the entire portfolio, the rest of the 90%. This is what we need to understand when we're talking about risk in portfolio. we need to understand that the risk is measured by the variance, the portfolio risk is measured by the standard deviation, and we talk about standard deviation and measurement of variance of the portfolio's return. I know we're talking about risk, but we also focused on returns. These things go together, arithmetic or algebra with geometry, and then risk with returns. So we need to talk about returns as well when we're talking about risk. Portfolio risk is not a weighted average of the risk of the individual securities in the portfolio. We're talking about the entire portfolio. We're not talking about individual scripts. We're talking about portfolios as in the rest of the business that we're doing. So if we were to be talking about analysis, if we were talking about immunization, if we were talking about risk, if we're talking about returns, if we're talking about expected returns, it's going to be different than realized returns, then we need to understand how we're going to talk about investments. Now, when we talk about investments, we talk about being able to understand, we're talking about portfolio as a whole. We're talking about being able to understand that these things need to be looked at as in total, as a total portfolio, and not as an individual script. Now, we have decided that we're going to build up a portfolio. We have decided we're going to look at the expected returns of the entire portfolio, and we're going to look at their weight or comparison with the entire portfolio's risk factor. In doing that, we do not consider individual risks to be bigger than the entire risk of the portfolio. Because we did our homework, we worked on the valuations, and we decided which were the best things to put into the portfolio. Of course, all portfolios are going to be different. We talked in one of the lectures that all risks are going to be different for different people. Portfolios may be made for youngsters, portfolios may be made for middle-aged people, or portfolios may be made for senior citizens. All will have a variance in risk levels. The risk levels of a youngster may not match the risk levels of a senior person. So, in looking at age factors and looking at expected returns, we must understand that portfolios are meant to secure people's investments, and we use that for diversification. In diversification, we tend to spread out risk, and we spread out returns, and then we calculate the returns with the risk involved, and we can talk about this in our next lecture, how risk reduction is done in portfolios. Thank you.